You call this kind of a pretty sweet spot for markets to be going into. Is that maybe a little bit Pollyanna, given the risks of a policy mistake, given the risks of what a much more contagious, if not a much more severe variant can do when it comes to that return to normality?
Yeah, it might sound a little Pollyanna-ish, and maybe I'm just in the festive spirit that I think that we're in a bit, or going to be in a bit of a sweet spot. But I actually think it's about a rational assessment of the various risks that are out there. Not only looking at the possible outcomes, but the probabilities around those different outcomes. And to us, a good base case is still that we have better growth in 2022. We have the slowdown in the third quarter of 2021, possibly extending globally through the fourth quarter. So we think that we could see that reacceleration of growth globally. And then also a lot of those supply chain issues beginning to resolve themselves just sort of by the natural functioning of the markets. Now, obviously, there's also been some concerted policy intervention as well to get goods off ships onto shelves and that. But for the most part, we think that we could actually be seeing that decent growth, lower inflation pressure. And so that just means central banks don't have to be in a hurry to take away the accommodation. And that's one of the reasons why we still think that this is a pretty favorable environment for staying overweight equities.
In terms of the Fed policy question, right? You're saying, just as they say that it's not transitory, you actually think that there is a chance that they will be proven wrong. Where does that leave monetary policy, and where does that leave the assessment of when we'll see tightening?
Yeah, it kind of comes down to, when I look at policymakers, I think about it in terms of how I look at investors as well. Sometimes you look for those moments of capitulation, right? When is it that the last bull has turned bearish, or the last bear has thrown in the towel and become bullish, those moments of capitulation? You can kind of see that on the policy front too. I think with the word transitory, where Chair Powell finally got fed up, he's like, okay, this has gone on a little bit longer than what we thought. He got to the breaking point. He's like, let's retire that word. Probably should have operationally defined how long that meant before he actually used it. But now that they've sort of embraced this idea that we have to do something about inflation, it's probably going to get to the point with declining inflationary pressures where there's not a lot that they really need to do. This can hopefully just resolve itself somewhat naturally as time goes on.
Brian, when then do interest rates actually anchor inflation? I'm sure you're getting inflation questions daily from your clients. What do you tell them?
Yeah, I'm actually working on a draft for the holidays for clients about inflation and what our outlook is. And I think that a lot of it boils down to just trying to put it into that context about, we had these extraordinary policies. And if the extraordinary policies become ordinary policies, then we would worry more about that longer term inflation outlook. Because right now it seems like what we have is really just a supply chain shock that has affected prices. You had a lot of demand, this purchasing power potential, confronting effectively a brick wall of the supply chain not being able to provide the goods and services that people wanted to purchase. Well, that's not a permanent state of affairs. That's more of a temporary shock. And it's something that is likely to last from, we think, throttling down from March to September of 2022, where we can see sort of this ramping down of the inflationary pressures. And then the concern about the large budget deficits, expanded balance sheets of central banks. We think that the budget picture is going to slowly improve. We're already seeing signs of that, I think, as far as with the being stuck in limbo with the Build Back Better plan. And then balance sheets are likely to plateau and then slowly shrink over time, where these extraordinary measures aren't going to become the ordinary course of affairs.
There's so much uncertainty out there, though, Brian. How do you write down anything certainly? I mean, we don't even know about Omicron yet and how bad it's going to be, never mind whether there are going to be future waves. We don't know what the data is going to be like in a few hours out of the United States. We don't know the picture for low-wage jobs, for example, or soul tax deductions.
Yeah, that's very true. And, I think that's why when you write these things down, it always has to be with humility, right? About, okay, what are the things what do we think will happen? But then what if we're wrong? What are those different scenarios? But a portfolio is a prediction about the future, right? You need to position a portfolio today about what is likely to unfold. And you don't know. But I hear a lot of people talking about markets don't like uncertainty, but the fact is, uncertainty is the bread and butter of markets. It's that difference of opinions, it's the difference in outlooks that means that investors get compensated for the risks that they take. And so our job then is to decide whether or not those risks are well compensated or not. And in government bonds, we don't think that there's a lot of value there, except for maybe as a diversifier of portfolios, because we have seen then equity markets sell off, those yields can come down and bonds can diversify, but they really don't do that much more for you. And so in some parts of the equity markets, like let's say energy, maybe Europe and emerging markets, we do think that investors are compensated for those risks.